Imagine preparing to co-sign a loan for a friend, right?
Okay, sure.
They're starting a new venture, they have a really solid business plan, and they basically just need your financial backing to secure the capital.
Sounds pretty normal so far.
Right, only the loan they're asking you to co-sign is for $100 billion.
Oh, wow. Yeah, I mean, that just completely breaks normal financial logic.
Exactly. You aren't just taking on a little risk at that point.
Yeah.
You are tying your entire financial existence to their ability to execute.
It forces a complete recalibration of how we even understand corporate risk, honestly. I mean, we are looking at numbers and credit guarantees that exceed the gross domestic product of several developed nations.
It's wild. Anyway, welcome to the deep dive. Our mission today is to unpack a series of really explosive reports from The Information and the Wall Street Journal regarding a highly complex financial maneuver.
Yeah, the scope of this is just massive.
It really is. We are analyzing a dynamic currently unfolding between Nvidia, OpenAI, and a company called SB Energy.
And this is such a clear window into the shifting mechanics of the artificial intelligence sector. Like we are finally moving from those theoretical software valuations to hard physical infrastructure costs.
Yeah, the actual concrete and steel. So our focus today is to analyze the real financial risks of this massive deal. We're going to break down the impacts of the proposed Ohio data center project that's sitting right at the center of these negotiations.
Which is a massive project in its own right.
Oh, totally. And we need to figure out exactly what this means for you, especially if you are an everyday retail investor trying to navigate upcoming tech IPOs.
Right, because the funding for these industrial scale projects eventually trickles down to the public markets. Somebody has to pay for it.
Exactly. Okay, let's unpack this. We really need to start with the entity actually tasked with building the physical foundation for these AI workloads.
Yeah, because, the software doesn't just live in the ether. It requires a massive industrial footprint.
So introduce us to SB Energy. Who are they?
Well, SB Energy is a subsidiary of SoftBank Group. They were founded back in 2019. And their core business model basically revolves around developing large-scale power and data center infrastructure.
Right.
They're currently building several massive campuses, specifically engineered to support the rising demand tied to AI operations. And crucially, they already have backing from OpenAI.
Okay, so the core of the recent reporting is that Nvidia is in talks to invest up to $3 billion in equity directly into SB Energy.
Yes, up to $3 billion.
Looking at the mechanics of this, I view it kind of like a company building a massive specialized highway just so they can sell more high-performance sports cars.
I like that analogy.
Right, Nvidia makes the chips, the sports cars, but those chips are basically useless if their clients, like OpenAI, don't have the specialized data centers, the highways, to actually run them on.
Exactly.
So Nvidia is essentially paying to pave the roads just to ensure their own sales pipeline doesn't bottleneck.
That highway analogy accurately describes the structural dependency perfectly, What's fascinating here is how an equity investment of this size from a chip designer into an infrastructure company shows how deeply intertwined all these markets have become.
The software, the hardware, and the real estate, right?
Right. Nvidia recognizes that the limiting factor for their future earnings isn't their chip design capabilities anymore. It is the physical availability of land, industrial cooling systems, and literally gigawatts of electricity.
Which is crazy to think about for a tech company.
It is. By taking a direct equity stake, Nvidia is vertically integrating their risk. They aren't just a supplier anymore. They are essentially part owner of this deployment infrastructure.
Which brings us to the epicenter of this entire deal, where that deployment infrastructure is actually supposed to be built.
Right, the Ohio project.
Yes. SB Energy is developing a massive planned data center project in Ohio, custom designed for OpenAI's workloads. And that $3 billion equity investment from Nvidia, that's actually just one component of a much broader, highly complex negotiation.
Yeah, the equity is almost the small part of the story here.
It really is. Because they are also in talks to provide around $100 billion in credit support for this planned Ohio campus.
And the credit support mechanism is really the crux of the financial engineering here.
Here's where it gets really interesting. I mean, how does a credit guarantee of that size even work? To me, looking at how Wall Street prices risk, this sounds a lot less like an investment and more like a massive financial safety net.
It is a safety net. I mean, when you are building infrastructure at the scale required for next generation AI training, the capital expenditure is just too large for SB Energy to simply finance through standard corporate debt.
Because the banks would just laugh them out of the room, right?
Well, yeah. SB Energy goes to a syndicate of banks for construction capital. The banks look at this highly bespoke, single-tenant AI data center and see huge execution risk.
Right. What if OpenAI pivots? What if the tech changes?
Exactly. So the banks demand a really punitive interest rate. But if Nvidia steps in and places its trillion-dollar balance sheet on the table as collateral,
then the perceived risk for those lenders basically drops to zero.
right, and the cost of capital for SB Energy plummets.
But the cost of capital drops because the liability simply transfers, right?
Yes, you've defined the mechanism correctly. A credit guarantee means Nvidia is legally binding itself to the debt obligations of this Ohio project if SB Energy or OpenAI default.
Wow.
It really indicates the staggering scale OpenAI requires to train its next-generation models. We are talking about custom-designed facilities drawing power that is equivalent to mid-sized cities.
That's just unbelievable.
And Nvidia is essentially leveraging its massive market capitalization to subsidize the construction of the exact facilities their biggest clients require to keep purchasing their GPUs.
But looking at this mathematically, if I am Nvidia, taking on a contingent liability of $100 billion is a massive exposure.
Oh, absolutely.
Even with a multi-trillion-dollar market cap, their annual revenue and liquid cash reserves are nowhere near that figure. If the Ohio project stalls out, that debt obligation doesn't just disappear.
No, it hits Nvidia's balance sheet directly.
Yeah.
And that is the exact tension driving the current negotiations. I mean, the tech sector has operated on this assumption of infinite growth and infinite risk tolerance for years.
Right, just go big or go home.
Exactly. But the reality of corporate finance is that every balance sheet has a breaking point. Guaranteeing the infrastructure creates a nice circular economy for Nvidia's hardware, sure, but it also creates a highly concentrated point of failure.
And according to Friday's report from the Wall Street Journal, that risk tolerance is already being aggressively recalibrated behind closed doors.
Yeah, that report was really revealing.
The journal reported that Nvidia has actually revised its plans to support the Ohio project. Originally, they had discussed a credit guarantee of $250 billion.
Which is just an astronomical number.
Right. But now, Nvidia is expected to initially guarantee less than $120 billion. And I should note here for our listeners that Reuters could not independently verify these reports, and neither Nvidia nor SB Energy responded to requests for comment regarding these specific figures.
Even so, the numerical shift there is critical to analyze. Dropping a proposed guarantee from $250 billion to under $120 billion is a fundamental restructuring of the risk profile.
Wait, $130 billion haircut? That is a massive downgrade.
It is.
If a corporate entity slashes its financial commitment by more than half before the ink is even dry, it suggests they're seeing serious red flags.
Oh, without a doubt.
If I am analyzing the Ohio project's fundamentals, I am immediately looking at the regional power grid. Ohio's infrastructure wasn't built to absorb the sudden, persistent draw of a multi-gigawatt AI training facility. Are they looking at grid saturation and realizing this project could face years of regulatory and construction delays?
This raises an important question about the volatility of the AI infrastructure boom in general. The power grid limitations in Ohio are definitely a primary factor, but the risk management goes deeper than just utility constraints.
Like what else?
Well, slashing a credit guarantee by $130 billion reveals severe risk management happening internally at Nvidia. They have to model the obsolescence risk of the hardware itself.
Oh, meaning the chips get outdated.
Right. Think about it. If they guarantee a facility optimized for today's architecture, and then a competitor, or even Nvidia themselves, introduces a fundamentally different chip architecture 3 years from now.
Something that requires totally different power routing or like new liquid cooling systems.
Exactly. Suddenly that massive Ohio data center becomes a stranded asset. It's useless.
So the risk is really twofold here. You have the physical risk that the local power infrastructure literally can't support the facility, and then the technological risk that the hardware cycle moves way faster than the construction cycle.
Precisely. Even the world's most valuable companies have strict limits on how much exposure they will take on a single client or a single geographic location.
Right.
By pulling the guarantee down to less than $120 billion, Nvidia's Treasury Department is enforcing a hard ceiling. They are acknowledging the necessity of the Ohio project for their sales pipeline, for sure.
But they are refusing to bet the operational solvency of the entire company on its flawless execution.
Exactly, they won't risk the whole ship.
Which naturally creates a funding vacuum, because if the estimated cost of the Ohio build-out remains the same, but Nvidia is suddenly retracting $130 billion of credit support, Well, somebody else has to shoulder that financial burden.
And they will definitely look for someone else to hold that back.
Right, and this is exactly why we are analyzing this deal today. Because Nvidia's move to cap its own financial risk means they are pushing a significant portion of the funding onto the public market, which directly impacts the retail investor.
Yeah, and the structuring of the equity investment we talked about earlier actually provides a clear roadmap for how that risk is being transferred.
Let's break down those mechanics. So the $3 billion Nvidia investment into SB Energy, according to the reports, half of it, $1.5 billion, will be invested when the Ohio project deal is officially signed.
Right.
But the other half is tied directly to SB Energy's planned initial public offering. SB Energy is aiming to go public as soon as next month, seeking to raise at least $5 billion.
Right, and tying the second tranche of that equity investment to a liquidity event like an IPO is a highly defensive posture by Nvidia.
So what does this all mean? Like, if you are a retail investor managing your own portfolio, you are going to see headlines next month about a massive AI infrastructure company going public.
Oh, the hype will be everywhere.
Exactly. The prospectus will highlight the backing of SoftBank, the tight partnership with OpenAI, and of course, the multi-billion-dollar investment from Nvidia. It is meticulously engineered to look like a ground floor opportunity in the AI hardware boom.
But digging into this structure tells a very different story.
Right, because Nvidia's own investment is contingent on the public market footing a massive part of the bill first.
Exactly. Buying into this IPO means investing in a company that is heavily reliant on one highly expensive, highly concentrated project in Ohio.
And a project with a slashed credit guarantee.
Yes. The retail investors being asked to provide the capital that Nvidia basically decided was too risky to guarantee themselves.
Wow.
If you buy those shares, you are taking on the execution risk of the power grid negotiations, the fragile construction supply chains, and the long-term debt servicing of the facility.
It really seems like a strategic masterclass in shifting liability, honestly. Nvidia secures the flashy headlines of a $3 billion investment, which brilliantly props up the narrative of unstoppable AI demand. And they secure the data center construction needed to house their chips. But by structuring the credit guarantee haircut and tying their equities strictly to the IPO, they ensure that if the public markets don't bite, or if the project faces huge cost overrun...
Nvidia's balance sheet is completely protected.
Exactly.
The tension here is really between the perceived momentum of AI and the stringent realities of project finance.
Yeah.
For retail investors and institutional buyers who are evaluating the upcoming SB Energy offering, those slashed credit terms should absolutely be the focal point of their due diligence.
They need to look past the hype.
Exactly. If the primary hardware supplier, the company with the most granular visibility into OpenAI's future requirements, is actively minimizing its downside, well, the public market needs to price that specific risk into the IPO valuation.
Because you aren't investing in the abstract concept of artificial intelligence at that point. You are investing in a utility and construction project.
Yes, concrete and power lines.
Let's pull all these threads together and just recap the incredible stakes of this deep dive. We're looking at a massive planned Ohio data center designed to handle OpenAI's next generation models.
Huge physical footprint.
Right. We have Nvidia negotiating a $3 billion equity stake in the developer, SB Energy, but strategically tying half of that capital to an impending $5 billion public offering.
Reflecting the risk.
And underlying all of this is a credit guarantee that was reportedly slashed from $250 billion down to $120 billion as corporate risk limits finally kicked in.
The entire maneuver really illustrates the transition from the research phase of AI into the heavy industrial phase. I mean, the capital requirements have completely outgrown the venture capital model.
They really have.
And now they are legitimately testing the limits of global corporate debt markets.
And as retail investors, you are the final piece of this puzzle. The major tech entities are looking to the public markets to help fund the physical reality of these systems.
Yeah, they need everyday money to build it.
They are actively structuring deals to ensure everyday investors help carry the financial weight of the concrete, the land acquisition, and the specialized power grids.
So understanding how these capital stacks are built and recognizing when the primary players are quietly hedging their exposure is absolutely essential for anyone allocating capital in this sector right now.
Because the infrastructure layer is completely necessary, but it carries a distinctly different risk profile than the software layer.
100%.
I want to leave you with a final thought to explore on your own. We started today by looking at the staggering reality of a $100 billion credit line.
Right. Just a mind-boggling number.
We analyzed how Nvidia, currently the dominant force in AI hardware, looked at the required financial commitments for the Ohio project and decided to sharply pull back their guarantee.
Yep.
So if the physical limitations of land and power require slashed guarantees, complex structured equity, and massive public IPOs just to sustain the data center build-out for one single AI company, are we approaching a breaking point? We really have to ask if the real-world physical cost of building the infrastructure for artificial intelligence is simply beginning to outpace the financial capacity of even the tech titans themselves.
It is the point where the exponential curve of software ambition intersects with the finite realities of macroeconomics.
Keep that intersection in mind the next time you see a tech infrastructure IPO hit the market. Keep digging deeper.